Time for our stat of the day. Global central banks have been on a rate-cutting binge this year. We all know that. But get this. There have been a whopping 32 rate cuts worldwide this year alone. And according to the markets, that's right, we've only just begun. Swap markets pricing in another 58 cuts around the world over the next 12 months. So how could this rate-cutting craze impact equities worldwide? Guy Adami.
I don't think it's particularly bullish. I love the Carpenters, by the way, as I mentioned in the break. Karen,
just terrible.
Fantastic song. One of the top 10 voices of all time. And she was a drummer. I digress. At a certain point, diminishing marginal returns. I don't know what the central banks are trying to accomplish, but when 30% now, I think, of global sovereign bonds have negative yields, that has to be almost by definition problematic.
But lower rates lead to higher equities.
Exactly. So you're looking on a multiple basis, and you're looking at money flooding into equities. That's what we've seen. And by the way, it's a win-win. When we've seen rates go up, even fractionally, money still comes into equities. When we see rates go lower, money gets forced into equities. So it's a win-win. I don't think rates are going as low as those 58 other people that were polled.
Well, it's for right now a win for U.S. equities. I mean, if you look at Japan, if you look at Europe, those equities don't look as good.
As long as we stay relatively higher.
As long as we stay relatively higher, because you have that kind of relative value trade, right? So at some point it ends, but for the U.S., it's okay for now. For the rest of the world, you do reach this point where you start to destroy the banks, you start to destroy savers. We haven't reached that yet in the U.S.
Won't our rates always be relatively higher because our bonds are more of a safe haven than other bonds around the world?
That's a big assumption.
Is it?
I mean, I'd rather own Apple bonds than U.S. Treasuries.
Huh. Pete?
I think the win-win, I think that makes a lot of sense to me as well. Because, I mean, when you're looking at this right now, and people have been running for this trade for a while now, Mel, I mean, you look at what's happening in the equity markets, we're 2% off the all-time highs. And if you look over the last 18 months or so, this move to the upside has been pretty amazingly fast. We're up 13% or more right now on the Dow as it is, just this year alone. So it seems to me that people are still hunting for what they want, and they're finding it here in the U.S.